Hey, welcome to a Wiser Retirement podcast. Leaving a financial legacy isn't something that happens by accident. It takes planning. We've put together a guide with 7 steps to leave a financial legacy and have made it available for free on our website. This guide covers designing your legacy, estate planning, financial education, and protecting your legacy. The link to download 7 steps to leave a financial legacy is listed in the episode description, or you can go to wiserinvestor.com, scroll to the bottom, and find it there. Now on to today's episode.
Hello, welcome to the Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, and with me today is my co-host, Brad Lyons. Hey, good. How you doing, Brad?
Hi, Casey.
So today, just as we're about to record this podcast, we get our new inflation number for the last year, 9.1%.
9.1. That is simply amazing. We haven't seen this. They keep saying the headlines are 40 years since. I don't know. It may be even longer. 9.1%.
Yeah, it's. I mean, as investors, all we can do is maintain our focus and our strategy to the long term. Obviously, stocks are going to do better in a temporary inflation environment, but if we keep climbing in inflation, there is a point at which companies can't keep up with that, and I don't know that we get there. No one's really talked about double-digit inflation, but we're technically 0.9 away from it. And some sectors have certainly seen double-digit inflation in that one sector. But this number is just showing the average across the board is a 9.1% inflation rate.
Yeah, I think that's key, what you said, that not every sector is experiencing it at the same level. There are some sectors that are experiencing higher inflation than 9.1%. And that's why it's difficult at this point in time to manage a portfolio by trying to predict which sector or which company in a sector is going to do better than any other company. It's just very difficult. So by maintaining a broad exposure to broad asset classes is the only way at this point in time in order to be in the markets and be participating in whatever sector, whatever companies are doing well through this period.
And then for conservative investors that don't want to tolerate stocks as much, and they've been holding bonds all these years, man, what a horrible year for bonds so far. I mean, look at the bond aggregate down over 12% year to date. It's really scary for every type of investor because we're in this environment where stocks are down. People expect that to happen from time to time, but people kind of grew accustomed over the last 30 years that bonds are pretty level. In fact, some bonds had given you a double-digit return in one year. Just not seeing that, and it makes sense just because basically, if you have higher inflation, your bond doesn't adjust to that. So that $100 that you're getting every month in dividends or interest is not worth as much, and therefore the price would drop.
That's right. I mean, for the most part, since the 70s, the U.S. has seen a bull market in bonds for the entire time as they went from high 16, 17% treasury, 10-year treasuries down to 0.6 as recently as 2020 or so. I mean, that's a long-term bull market. Investment managers have been calling for this reversal for years. Thought it was going to happen several years ago, and it didn't happen. Rates continued to go down.
They thought it was going to happen in 2010, 2011.
That's right.
Yeah. For those that got too conservative back then, they missed out on double-digit bond returns over that time period. It's so hard to time.
Yes.
Very hard to time.
Bonds are an extremely important piece of a portfolio. And the best way to manage them is probably not to tinker with them too much. They will self-adjust as the maturities come due, and investment managers are able to reinvest those maturities at higher interest rates.
Yeah. I mean, you think about just mortgages. So a good example that people seem to relate to is on the mortgage front. If we were doing 1.9 to 3.5% mortgages a year ago, and now mortgages are 5 to 6, that means as new mortgages hit the funds, that the yield is going up, which means you're getting more money. So the price has dropped, but bond income is on the rise. And I think that's the important thing that I'm actually excited about, because it's been decades since we've seen bond portfolios generate solid income.
Yes, savers will start to finally see some interest on their savings, and bond investors will start to see some payments on their investments. So it's it could be as the pendulum is swinging back in the other direction, the time for savers and bond investors is coming.
Yeah. And that's positive. It's positive that it happens. Unfortunately, though, you're going to have a lot of people bailing out of bonds. And I don't think that's such a good idea. We still have risk out there of a recession. And, right now we have an inverted yield curve. I was reading this in the paper yesterday. We have an inverted yield curve. So which basically means, I believe it's the 1 year is about 0.8 less than the 10 year, or more than the 10 year. So your ultra short term bond is now yielding higher than a 10-year bond. And that's typically a sure sign of a recession. Now, when that recession happens, this is where it's kind of laughable, is within 5 years.
Yeah.
But if you drop down to the 1 month treasury, and you compare that to the 10-year treasury, right now that's still normal, where the 1 month pays less than the 10-year. And they say that's the one that's definitely 100%. There's a recession immediately if that gets inverted. So if we want to be optimistic that, the sure sign that we're definitely in a recession is not giving the red signal yet. However, it's going to be very interesting if there is a recession called, which we'll know in a couple of months. If we're in a recession, maybe less than that now. It'll be the funniest recession ever. I mean, not laughable funny, but just
right.
Odd.
And that's what economists and investment managers are saying. If we go into recession, this will be the strangest one they've seen in their careers. We just had a job unemployment. 300 and some thousand jobs were created. Last month in the month of June.
So ultimately,
we have all these cross currents that are occurring. It's not just inflation. It's not just interest rates. It's not just the supply chain. It's not just what's happening geopolitically over in Ukraine and Russia. It's all these things that are mixed together and providing mixed signals. So when we talk about the yield curve being inverted, really it's a data point. It's a data point that economists have looked at, and they've used it to either predict or confirm some sort of economic condition.
Well, then you also wonder about going back to the bond conversation. If it becomes a deeper recession, they stop raising rates, or they're going to lower rates eventually. So when they lower rates, bond prices go up. And so, if anything, you look at all the dividend or all the interest reinvestment you can do now. If it gets really bad and they have to drop rates to spur the economy on in the future, then you're in a really good position inside your bond portfolio. So it's hard to see that when you're experiencing what we're experiencing now. But it's important to stay the course. It's also important to have good financial planning, simply because if you don't have enough cash reserves and you're having to sell bonds at a loss, you're having to sell stock at a loss, you're destroying wealth to live on at that point. And that honestly, Brad, that's something I learned in the financial crisis back in 2008, and why I'm so passionate, and we're passionate as a firm, that cash reserves be monitored, that our clients have enough in reserves that they can weather these kind of storms. And if they're retired, we hold the reserves for them to make sure that we can weather the storm. So these are definitely interesting times. The airplanes are loaded, hotels are full. I don't see any signs where people aren't spending money. They aren't buying retail items as much. Those sales have come down, but they certainly are still spending money. And it's going to be interesting to see where that shifts in the next 6 months. And do people really stop spending? If you're creating new jobs, people feel good. They're out there spending money. So it's going to be interesting.
It should be. This is why economists and investment managers who are looking at this, such as us, are going to find this, if it goes into recession, one of the strangest ones ever, where you actually have increasing employment, okay, and
negative GDP,
business activity at the same time.
Right.
one of the things that's happening, since it's the summertime, we're seeing the airplanes filled, as you said, the resorts filled, but in a couple of months, we'll be back to fall. Okay. So will there be a turnover, in how people spend their money? So if they're spending it on vacations and travel and experiences, they're not spending it so much on retail goods right now. And we're starting to see some sales in stores, because inventories are increasing. So what we may see is that people go back to spending on goods rather than services later in the year, and the economy will shift some more.
Well, I thought that was interesting. We do have to get back to our main topic, though. And our theme for this quarter is legacy planning. We one of the components of legacy planning is building a team to support your family now and the next generation. And what we're going to talk about today is just how do you choose a financial advisor to help facilitate your legacy plan. And based on our prior podcast, you can to talk about we talk about what is legacy planning, why it's important. Ultimately, I don't necessarily think we should get into that today, but more of like, how do you choose an advisor? And I tell prospective clients all the time that the barrier to entry to be a air quotes financial advisor is very, very low. All you really have to do is take a test, which isn't that hard. You get your certification. The certification has nothing to do with good advice at all. It really has more to do with industry regulations and not taking people's money, which unfortunately still happens. But ultimately, it really depends on the type of company that the advisor is working for. And if you want to break it down, there's two sides of the business. There's people who sell stuff and there's people who give advice. And it both looks very similar to the person who doesn't know the difference. In fact, they even call themselves the same thing. Maybe not officially a financial advisor on a business card. It might be registered rep or something along those lines. Ultimately, and then we have industry designations like the CFP. Well, the CFP can be used by people selling product and the people actually giving you advice. So what does all that mean? And it can be very confusing. I think that there's a couple of ways that you can filter things out really fast. And, number one is, what are your goals and objectives? Are you looking for holistic advice? Are you looking for a quarterback to help you with, financial planning and investment management and taxes and estate issues? That person is not going to be found in a like a Wells Fargo environment or a Edward Jones environment, unless you get into like private wealth at those areas. And that's probably what, $25 to $30 million to have someone at that level really take control of things. So ultimately, what are your goals? Is it just to buy a stock? Then maybe you just need a person who invests in individual stocks or whatever. If it's a plan, ultimately you need someone that's subjected to the fiduciary duty rule. And in my opinion, every advisor should be a fiduciary, but that's not the reality. In fact, minority of financial advisors are fiduciaries. And fiduciary standard basically means that you have to work in the best interest of the client, period.
Yes. And I think that one of the ways that a prospective client, prospect, somebody who's looking for advice can find it is to inquire not just about the competency and the background of the advisor that they're talking to, but the structure of the firm that the advisor works at. I think that is so important. And you and I have talked about this in great deal relative to the structure of the firm can promote trust before trust is earned between the advisor and the client.
Yep. So another test is, what can you sell me? And if the answer is I can sell you these products, that's a great way to say thanks, but no thanks. You never want someone with competing interests. And even fiduciaries can have competing interests. There's people that are fiduciaries that still sell products, and the disclosures get buried. And so ultimately, I believe as an industry, and this is not really how to choose a financial advisor, it's more of how to elect people into government who understand this stuff. But I believe as an industry, the product should never pay the advice giver. That would solve the whole problem. Don't worry about fiduciary standard, not fiduciary standard. Just say it's illegal for any advisor to receive any type of payment from any product that they're selling. And immediately all the garbage that gets sold out there will disappear, because there'll be no incentive for people to use it. I mean, I'm not talking because, oh yeah, I know about that. I was in that industry for 12 miserable months. I started my career off of that industry. And I remember people walking down, or my managers walking down the aisle at the firm and saying, hey, there's 3 people in this relationship. 2 better be making money, the company and the advisor. That's the most important people in this relationship. And it was heavy annuity sales, heavy whole life insurance sales. And you make a lot of money. That's where the biggest producers come out of that realm. And so, you still have to sell something that's suitable, meaning that you have to sell a product that's suitable, but it doesn't mean that you're selling the best. It's like going to car shopping, right, Brad? I mean, you go to the Ford dealership and they say, hey, this F-150 is the best there is. But what if you had a dealership that had an F-150, a Ram and a Chevy and Toyota, whatever, and we chose the right truck that met your needs because we had all the trucks available that are produced? That's what it's like on the fiduciary side and the fee only side, where we're not selling product. And honestly, the portfolio is really free at that point, because most of us on the independent side, we're not using these expensive mutual funds that really don't have any long-term traction. We're using low-cost index funds where the portfolios are less than 0.1% a year in fees, and everything trades for free.
So another way to look at this relative to not being able to collect commission from a product sold is to, from a client standpoint, never take advice from the people who custody your assets. Okay. Who custodies assets?
True.
Brokerage firms who have proprietary products. Who custodies assets? Insurance companies who sell annuities. Who custodies assets? Mutual funds,
Right.
So by not taking advice from people who custody your assets, you're actually going outside that realm and finding somebody who's independent of the custody aspect of your money to get advice from. Okay. So you're creating a kind of a 3-legged stool, if you will, which is very strong. You have yourself, you have the custodian, you have your advisor. And these are 3 separate entities that are used in order to confirm and, audit at the same time. So, For example, the way we're structured, to go back to structured, we do not custody anybody's assets. We do not custody any client assets. All the assets are custodied, say, on TD Ameritrade, as people know, that's been bought by Schwab. So we're providing advice to the client and then implementing that advice through the portfolio we're not custodying. So we have no affiliation with the brokerage firm. We have no affiliation with an insurance company. We have no affiliation with a mutual fund company, a bank, a trust company, or any other financial services firm that might provide us with a stream of revenue based upon the recommendations that we make. Okay. We don't have any of those affiliations that do that, such as insurance agents, brokers, in the world, et cetera.
So ultimately, to go back to legacy planning, that then filters it down even further, because when you're building, when you have a legacy plan, meaning you've got your estate planning done, you need portfolio management, but you're fine yourself, you've taken care of yourself. Now you want to start building things for the next generation and beyond. Could be a business, could be real estate. It could just be stocks and bonds. That's usually it's all 3 of those things. But ultimately, a financial advisor that you're looking for needs to become the family CFO. It's the quarterback for the family that is coordinating with the CPA. that is coordinating all the tax planning and business decisions with the attorney as well, with risk mitigation and passing of assets. It's communicating with his or her own investment team. It's not going, okay, yeah, you have this real estate over here. That's great. But here's what I can do for you in this portfolio. They should never be incentivized to tell you to sell something else to put more money in their account, right? That goes back to how you're compensating. More than likely, I think a proper legacy planning, you're typically going to have more than $5 million in assets, even investable assets. So talking about those numbers, I believe it should be a flat fee. You never want to have an advisor that's getting paid a percentage of assets under management, because his or her incentive is always going to be to grow their book of business. You want them incentivized to think about future generations and how you can continue to add wealth to your family. And I don't believe that's in stocks and bonds 100%. I believe that real estate plays a big role in that. Or even if you're in your own business, when we had or still have a family that operates, I believe it's 25 plus assisted living facilities. And I remember conversations in the past, hey, I have this extra $1 million. Where should I put this? And quite honestly, I'm like, look, you're in the hottest growing industry in the US right now. You have aging demographics moving your way. You understand your business. I would put it back into the business and keep growing that wealth through the business. And they've done that through, managing different properties versus just building and managing. Now that had nothing to do with me. I'm just the guide, right? And there's also been times when I thought, well, it's getting a little heavy in the business. We should look at things outside that, right? And they did their own job of choosing their own primary properties to where those are good investments. But it's taking a look at the entire picture as a financial advisor and saying, okay, this is our strategy going forward. We've had other clients come in with maybe too much real estate. They're a little cash poor, and we had some liabilities. And so we need to shift things around a little bit to create the liquidity that we need to live on, and also still participate in vacation rental properties and still participate in obviously the overall stock market. Ultimately, for typically high net worth families, we're also got to be the quarterback on the tax front, because you have CPAs that are doing their job in filing taxes, but they don't control the gain losses inside the portfolio. So it's coordinating with them and saying, hey, if they happen to have how business works, you can have a good year, but still have tax write-offs to where it's a flat tax year, to say, hey, we have IRA conversions that we like to convert to Roth. And how does that work into the tax strategy? And so it's coordinating that. It's coordinating capital gains to say, we're going to take these gains. How does that affect return? They can say, oh, no, not this year. Let's do that next year. Okay, great. We'll come up with a plan to coordinate that next year. Then we have this huge drop in the market like we just had, Brad. And what have you been doing for the last 4 weeks?
Tax loss harvesting.
Tax loss harvesting. Yeah, it's going through there going, man, we have these losses. Let's realize these losses. Let's build this huge tax credit. The money's still invested. We're not selling and going to cash and sitting there. You're out of the market for what? Maybe 3 milliseconds. I mean, it's really
the point. Yes.
It's a really fast transition, but we transitioned the portfolio to something similar that was already into to create these taxable events. So now we have clients sitting on $60,000, $70,000 in realized losses. Yet when the market rebounds, they're going to rebound just fine, if not better.
The structure and the integrity of portfolios maintained when tax loss harvesting is done properly. You just set up these taxable losses that you can harvest year after year after year, or whenever there's a large capital gain that comes your way. So it's a great tool for utilizing with other types of assets, being real estate, business, etc., where you can, because you never lose the benefit of the tax loss until it's expired, until you've used it all. It's exhausted is a better word. Yeah.
So, you and I, Brad, have gone into this in depth. We have episode 54, hiring the right financial advisor, in our podcast series. We have a series we have a little fun with, avoid the financial advisor who ... Episode 21. You can go back and reference that. Even on our YouTube channel, which is also called A Wiser Retirement, you can search for what is a certified financial planner. We talk about that designation and what it means there. So we've talked about this a lot, but ultimately for people who are really focused on legacy, they tend to have higher assets. So with the higher asset number, how would you go and interview that person? So you're the client and you're walking to a firm. You're a successful person. You've done well in business. You've done well in something. Maybe it was a large inheritance because your family was your family was really good at that. There's a lot of fast elevators and pretty waterfalls and lobbies in Buckhead, right? In our financial district. I mean, there's some really impressive offices down there,
but they weren't free. Yeah.
But well, that goes back to fees, and that's a little different discussion. But you think about that. I mean, what questions do you ask the person? My first question would be, are you fee only?
Yeah, you still want to know if they're a fiduciary and if they're acting in your best interest with all their recommendations and advice to the fact, are they a fiduciary? And are they trustworthy? And is their firm structured in order to promote that trust before it's actually earned, right?
Yeah.
So you want to know exactly what that they can do on a long-term basis for you, because implementing these types of plans are not a one and done thing. These plans last for years. And in fact, an estate plan should have a 3, 5, 10, 20-year plan strategy in order to either utilize assets or work their way out of assets and have an orderly transfer from generation to generation. And are they going to be able to guide that transfer when the event occurs? Because the person is not there. So they're setting up trust that they cannot oversee when the event occurs.
And then, and I think the question we get most often is, how do you work with my CPA or my attorney? Or they say, I really want a one-stop shop. Like, how do I use your CPA services and your estate planning services or legal services? And for us, some firms are large enough to have all this in-house. For us, we coordinate with a local CPA firm, all from big accounting firms. There's no lots of experience in complicated things, I guess, is what we're focused on. Then we actually have 2 law firms here in town that have not only estate planning specialties, but so many other specialties as well that we're able to partner with. And so it's explaining how that relationship works and how we coordinate and how we can talk on not necessarily behalf, but talk with that other advisor freely about the client, and they know who we are, and we're not here to second guess them. We're here to support them. I think that's a question that I would be asking certainly an interview. And then ultimately, we do this all the time. People ask for references. And you're going to call the reference up, and of course they're going to say good things, because the reference isn't going to, they wouldn't give you a reference they weren't going to say good things about. But you can talk more candidly, about what you're looking for if they think that advisor would be good at that.
Ultimately the financial advisor, if we could almost take away the word financial and substitute the word trusted, in this sort of circumstance, how do you find a trusted advisor?
Right. Yeah.
And that would be ideal, obviously, where you have a trusted advisor sitting in the center with you, and you have a hub and spoke arrangement with other advisor teammates, I guess, as you could say. And that is your CPA, your trust attorney, the insurance agent, the real estate people, et cetera, and business, managers. So it's somebody who sits in the center with you and sees the whole picture. They see the entire landscape.
Yep.
If you try and do it by yourself as a person with wealth, and you go to a CPA, the CPA is going to give you the best advice the CPA can give you in that slice. Okay. If you go to an estate attorney or commercial attorney and you ask them, they're going to give you their best advice based upon that limited knowledge. Okay. And so on and so forth. It's the trusted advisor And it's often the financial advisor, but it's the trusted advisor who sits in the center with you and sees the whole picture. Okay. And gets everybody to understand that anything they advise on has an impact over here. And we talked a little bit about this. If we take a capital gain, it has in the portfolio, it has an impact on the taxes. So the CPA person needs to be and should be involved. Okay. So it's understanding the team structure and where that trusted advisor, often financial planner, okay, can sit with you and guide you through these choices and the teammate selection, quite frankly.
I think ultimately, if you sit down with an advisor and all they talk about is portfolios, I mean, that's a great way to start a conversation, possibly, because it's something tangible you can show them. But if all they talk about is portfolios and portfolio structure, and that's it, I think that's a red flag these days, quite honestly. Robots can develop really solid investment portfolios. We don't need people for that anymore, quite honestly. What we need is someone looking at the larger picture and saying, okay, great, yes, this $5 million, we're going to invest this manner. That's an important conversation. But hey, I noticed this is all your money. So where's your reserve? Right? How much of a reserve do you need? And maybe we need to take $500,000 and put it in reserve based on your lifestyle, or 200,000 or 100,000, or maybe 50,000. It's looking at all the roadblocks. We're finding, as we do our review meetings, we're finding that we have a tremendous number of people that have uninsured homes. I had one client didn't even have hurricane insurance on their home down in Florida, right there on the beach, which is a little complicated. It's not as dumb as it sounds, but it's for us, it's coordinating with property casualty people, because you and I aren't going to be seen at a property casualty conference. How boring would that be, right? Talk about insurance all day long. But there's people who love that. And so we lean on our experts to analyze this for clients. That's what a financial advisor is doing. It's looking at the entire picture, not hanging their hat on, I pick good stocks.
Well, how many times have you and I talked about, and how many times we end up advising clients to utilize money in their portfolio to pay off their home mortgage? Now, remember, to increase discretionary income for somebody, you can either raise revenue or lower expenses.
Right.
If we can lower their expenses on a more efficient manner by utilizing money in the portfolio, we can actually increase their discretionary income for them to live on in retirement rather than and securing a paid for home at the same time. So we don't make any money, obviously, from a revenue standpoint, but what we're doing is acting as a trusted advisor, looking after the well-being of the client in every aspect.
Well, it really comes down to, starts off with a fiduciary fee only, not fee based, but fee only platform. And then you have to build from there. Do they have the ability to handle the comprehensive plan, which includes property casualty, estate planning, insurance, right? Can they do all that tax? Can they do all that and coordinate all that in-house? And then ultimately, what are the fees for that? And that's how you compare different firms. But and also size. I mean, some people want to be at a really big firm because they feel secure knowing that if something goes wrong, that there's multiple people there that could help them, or they feel like, it'll be around longer. And to be fair, there's a lot of consolidation in our industry right now, which is probably less disruptive to the client than it used to be. And then some people want to have, I want to have this one person. I think there's risk in one person if it's a one person shop with an assistant, because if that person becomes disabled, who's running the show? And a lot of times those firms haven't found efficiencies in processes yet. And so literally one person has it all in their head. And that's not a good way to conduct legacy planning if you only have one person that can help fulfill that legacy, right? Where medium-sized firms, tend to be what people will gravitate toward, because they do have direct contact with advisors. But at the same time, there's enough redundancy in the system that if that lead advisor were to get hit by the the Mack truck, so to speak, that the legacy planning still lives on. But I don't know. We could talk about this for hours. I've often said I wanted to have a show just on dumb advisors and the dumb stuff they do. We get industry public. I get a weekly email. I'm sure you do too, Brad, about all the things that the government finds wrong with these firms, and it makes headline news. But ultimately, I will add this, Ponzi schemes and all the horror stories that you hear about, you got to have the advisor separate from the money. Advisor should never be able to touch your money.
Right.
So for us, that's Schwab and
never take advice from people who custody your assets.
So Schwab and TD Ameritrade hold the assets, but that's all they do. They don't advise on it. They just hold it. We advise the client. And then of course we do all the trading and all that's necessary as managers of the account, but we can't grab the money and run. And that's an important part that people miss. They get entranced by some of these bad actors because they're really good at talking. And they end up losing a lot of money because they have direct access. They wrote them a check directly, or a company that they control, right? We don't control TD Ameritrade or Schwab, where if you wrote the check to Wiser Wealth Management and I happen to own my own broker dealer, then the money's still available to me. And that's where the relationship goes wrong.
Right.
So,
okay.
All right, Brad, another good conversation. Hopefully we can get our hands around this inflation problem and get back on track market wise. But I think to everyone out there who's invested already and they're watching values fall, just remember that it's a long game. It's not a short game, right? And it's not a casino. So it's not like we go, man, I'm down $200. I'm gonna go home. In this case, going home costs you a lot of money. So stick with the plan, make sure you have enough cash reserves to be able to live for the next year to 2 years. And it's all going to get better. It always does.
It always does. Okay.
All right, Brad. See you.
See ya.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We would also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. We would love to hear from you. This episode was produced and edited by Lilton Moore. This podcast is strictly for informational purposes only and is not to be considered as investment advice or a solicitation to buy or sell any financial products, securities, digital assets, or any other investment vehicles, or a basis to make any financial decisions. Wiser Wealth Management Incorporated is a registered investment advisor with the SEC. The host and/or guest may personally own securities, digital assets, or other investment vehicles mentioned on this podcast. Neither the host nor guest of the show are compensated for their participation, and no referral fees are paid to or received by any host or guest for clients, listeners, or similar interests. Investments involve risk, and unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor, tax professional, insurance professional, and/or legal professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.